We got lots to talk about today, folks, on today's show. I mean, we're going into here to September. We got a lot going on in the markets right now. They always say September starts off weak, and it does start off weak. But you know what? We're also coming to an election year, and we're coming already off some really strong numbers in the market. Now, when you look at 2023, we had a fantastic year. 2024 year to date, of course, then September rolls around. It's been a bit rocky, but at the end of the day, these are normal circumstances that come about. Now, I just want to highlight some items here that happened earlier this year, and this has widely been ignored by multiple people in the market and in the economy, in the industry. And that is that a globally diversified portfolio is still important. Like I said, we have lots to talk about today, but do you know that small cap stocks versus large cap stocks, now historically speaking, small cap companies outperform large cap companies by a substantial amount. Historically speaking, they do 12-13% return versus a 10% return. That's a 20 to 30% outperformance. Now, when you take a look at large cap companies for the month of July, did you know that small cap stocks did over 10% compared to the S&P 500 that did 1%? That's like the third best performance on a monthly basis alone ever. I mean, we're talking substantially, especially since small cap stocks really came out in the late 70s, but the idea is that it is huge. Now, the reason I bring this up is because when people are just fed up with small cap companies, international companies, and just completely annoyed with what's going on, that's when people start thinking of themselves, maybe, just maybe, they should be looking to go into big tech. Right? Because we're always going to use Google. We're always going to use Amazon. Seems like Facebook, we're always going to be involved there. NVIDIA seems to be great, right? I mean, we start looking at all these large companies, Microsoft, Apple, right? We're always using them. They're always going to be profitable. The rich will just get richer. And then it's funny how the market just says, no, 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 wait, and not so fast. It's just kind of funny to me how that works out. And sure enough, you have small caps making a tear. You got almost over 10%, but over a 9% outperformance in 1 month. I'd be happy with that in a year. Just crazy to me, right? When you start thinking about it. And then also when you look at growth companies, how they've just been absolutely tearing up value companies for quite some times. And when you look year to date this year, when you take a look at large cap company growth, they are still outperforming value. But wait, look at July again, this outlier of July, where value companies did 5%, while growth stocks did a roughly negative 2%. Now performance by 7% roughly. I get it. They're still up year to date. I get it. Now September has been a punch in the face. You saw what happened in NVIDIA. So the idea is diversification seems to be the key, but yet again, it's so easy to ignore. I'm just sharing data with you just on how things are going so far this year. And don't fall into the feud and frenzy of the market. Like I said, things are going on all the time. We just have to be consistent in our long-term approach to investing. You're not investing in an individual stock. You're investing in a portfolio long-term. There's going to be bumps in the road, but you have to take advantage, right? You have to buy when it's on sale. You have to sell when you made a lot of money. Heck, it could have made sense to buy small cap companies earlier this summer, and then all of a sudden it has a 10% pop. Now your portfolio's out of whack. Take your profits off the table. I don't care if you have 100,000 or 100 million. It makes sense. And I get it. 1% move on a $100 million portfolio is $1 million. But still, folks, please, come on. Give me a break. The idea and logic doesn't change. And that is you stay invested and you pay attention to what's going on. And as the Feds and interest rate cuts are happening, you have to also look how bond performance typically happens 12 months after these rate cuts. Because you got to think, if you have a 5% bond today and now tomorrow the rates go to 4%, everybody wants your 5% bond. It's high in demand. I'll even pay you more than what you paid for it. Why? Because you're getting an extra 1% a year. And that's not over 1 year, 5 years. It could be over 10 years, 20 years, and so on. Rate cuts are huge in a situation like this, which is why 12 months after the Feds cut rates, On average, the core U.S. bond index does 7.2% on average. Short-term bonds, 4%, 4.2. Money markets still roughly 4.2%. High yields are about 0.8%. Why? Because people are looking into deploying their capital back into bonds. And high yields, you don't have to take as much risk anymore to get the yield that you want. People are content and need that 4 to 5% for life to live and sustain their lifestyle. It's just crazy to me yet again that we just don't see this often, where people are chasing yield. It's funny to me when I see people that are chasing maybe a REIT stock or whatever the case is. Oh, it's yielding 10 to 15%. Hey, this investment here is paying a 15% dividend. Yeah, but look at the performance of that holding. How has it done in the past 5 years? It's actually lost money, while the market has done much more than that. It just frustrates me so much, because just people are not looking at the overall picture. By the way, folks, if you're just joining me, you're listening to Gabriel Shane, certified financial planner, and your host of More Knowledge, More Wealth here. And every weekend, we're talking about all important topics of personal finance. And today we are just talking about the basic concepts of investing, and we are looking at how the markets are going in general. And when we take a look at just the average performance in general, just of how markets have done, it's very simple to say it's a 10% return, but it's not flat. Some people are like, you know what, I'm going to fire my advisor because I can get the same thing, same return by just doing the S&P 500. They can't beat the S&P 500. Nobody can outbeat the S&P 500, so why would I pay somebody to do that? I'm disciplined. I get it. I can handle the roller coaster. I don't need an advisor. I can manage my own money. S&P 500 all the way. Whoop, whoop. For those watching on the podcast here, you get where I'm saying? So people are actually thinking about this, but the S&P 500 is an asset class. You know what I tell people like that? You must be under 40 years old. Seriously. Because you probably, maybe under 45, maybe under 50, depending on how late you started investing. People forget from 2000 to 2009, $1 million is $900,000 after that 10-year period, assuming no costs or no fees or no anything. Versus a globally diversified portfolio is almost doubled. And that's not including taking advantage of the ups and downs of the market, the rebalancing piece, which, as Vanguard likes to say, can add an extra 1% to your portfolio. Well, 1% is quite substantial over a 10-year period, right? That's 1% a year compounded out. That's almost over $100,000 more. So these are the things that people don't take into consideration because they're so blinded by the early success that's right now what's happening in the tech stocks. That's all they're focusing on. And by the way, those magnificent 7 companies is representing about 70% of the returns of the overall market. Crazy to me that people are just not taking that into consideration at all. They're just wanting the next shiny thing, the next cool thing. How many people were thinking about buying NVIDIA? You know when you should have bought NVIDIA? When nobody wanted to buy NVIDIA. These are the things that I just get extremely disappointed because so many smart people are out there and people let their emotions mess with them. People are so more sensitive now, so much more sensitive. They are wanting things now. We are in a generation of now. Heck, look at the Amazon. I recently, Ace Hardware had this thing for my car that was $1.99. I think it was even $1.79. I couldn't have time to go to Ace Hardware. So I ordered it on Amazon for $5, free shipping. You get what I'm saying? We're just in a time where people want it now. And I kept pushing it up. It's a week has gone by and I still haven't done it. So I'm just saying to you, what are you doing in your situation? If you want it now, investing doesn't work that way. That's why so many people fail in it. I'm just telling you, this is where it's important to reassess your situation. What worked for you yesterday may not work for you today. I don't understand how that's not a hard concept to capture. You have to look at what the overall risk level of a portfolio is. And if you're unhappy with losing money, you're taking too much risk. And I get it. Our industry is filled with commission-based advisors that want to sell you a product and make commission. This is why Falcon Wealth is a fee-only, less than 2% of the industry, fee-only, non-commission, independent RIA company where we're legally obligated, legally liable to do what's in your best interest. This is why we're offering a free financial assessment. We recommend you give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's Falcon, WP.com for short. We'd love to help put this together so we can answer the questions that you have and relate this show to your specific situation. And we got offices all over, like we say, and we can help. But what we're going to do, we're going to come back. We're going to talk more on the markets, and we're going to talk about the average performance following a bear market. We're going to talk about inflation and sheltering housing, and we're going to talk about the asset classes that are positive this year. Folks, we'll be right back after a few words. This is Gabriel Shaheen, Certified Financial Planner and President of Falcon Wealth Planning. We wanted to offer you a free financial assessment for listening to the show so you can help relate it to your specific situation. We offer multiple services such as retirement planning, where you are today, how retirement looks like, talking about Social Security, real estate, planning, even if you own a business, talking about taxes, not just how to save money today, but also throughout retirement. Talk about investments, making sure you're avoiding those high fees, costs, commissions, and also estate planning and insurance, just making sure you're properly protected if, God forbid, something were to happen. And we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's Falcon, WP.com for short, and fill out the form fill right there on our site. We would love to help you in your financial situation. We look forward to serving you. Welcome back, folks. This is Gabriel Shaheen, Certified Financial Planner, and your host of More Knowledge, More Wealth here. And every weekend, talking about all important topics of personal finance. And today we were just going over how the markets are doing, how the asset classes are doing. And I thought I would switch the segment discussing, because as we discussed in the first segment, we talked about small caps, we talked about value, we talked about interest rate cuts and how stocks and bonds typically do. But I want to talk about as we enter volatility leading to the political season, as we saw it in September, we want to spend a minute to talk about how I love bears and bear markets. I really do. I know bull markets are great. They're going up. Everything's fantastic. Everybody's happy. Heck, we've had one in 2023 and part of 2024. Heck, we had it prior to 22 when we fell into a bear market. And then we had it in 21, 20, even through the micro drop when the market dropped 40%. Stock market ended during COVID up 20%, 2019, 2018 with a bit of a hiccup, 17, 16, 15, 14, 13, 12. Like, these are all years that the market was just booming, right? But this all came off a really big bear market. And bears, why do they call it bears? They talk downwards. What do bulls do? They hit with the horns and they get you in upward. But I love bears. Why? Not just because I like grizzly bears and they're cuddly. I like the fact that bear markets, you're buying low. And when you take a look at just the simple, most basic concepts of bear markets, the average bear market, this is information since 1950, has returns after 1 year, following the bear market, of 40%, 39.6, 1 year returns. This is why I love bear markets, because when everybody's fearful, you got to be greedy as hell and buy. Now, that's what we do for our clients, of course, naturally. But that's also what you should be doing, right? Clients freak out. They start thinking, oh my God, I got this the other day. This was crazy. Blew my mind. Actually, I think I did a social media post on this. Somebody said the following: I have $1 million. I just put in $50,000. The market dropped 10%. And I now have $900,000. Not only did I lose the $50,000 that I put in, but I lost another $50,000. I literally lost my mind. I'm like, what are you talking about? You lost 10% on the $50,000. You lost $5,000 of the $50,000 you put in, and then 10% of the remaining $1 million, which was that $100,000 drop. It's crazy how people think like, I just lost the $50,000 I put in. Where did it go? I should have never put it in. It's just crazy, the emotional aspect people have that pisses them off to make such drastic, hasty, incorrect, poor, bad decisions. Can't think of any more synonyms to say. And when you look at the recovery, after a bear market of almost a 40% return after 1 year since 1950, there's been 12 bull markets, and then the average 3-year return is almost 16%, and the average 5-year return of 11.5%. I tell people, stop thinking you're smart. I want you to lose money in a bear market so you can stick around for the reward. You got to get hit with the bear so you can ride the bull. And this is where people fail time and time again, and it pisses me off. Why? Because unfortunately, I just like people, and I love helping people. And people don't listen. That's why I love my clients. Why? Because they pay us. That's not why I love them, not just because they pay me, because they respect and appreciate what we have to say. My mother tells me to talk to her brother, my uncle, and he wants to buy a property in the middle of nowhere because one of his cousins live there, and it's a terrible idea. It's a terrible investment. It makes no sense to anybody. They're only going to have to pay costs for landscaping and property tax for the sake of what? Of an appreciation play? It makes no sense at all. And oh, by the way, they're approaching retirement. I would rather put my money in the stock market. Has a much higher probability than a land deal in the middle of nowhere. What, maybe in 20, 30 years from now? I think he was thinking he was going to put his RV there when he travels. So he has an East Coast exposure. He lives in California. I'm like, that makes no sense. You can pay $50 a day, $75 a day for space rent. You still don't have sewage. You still don't have water. You still don't have electricity. You still don't have shower unless your RV has it. You could. That's what you pay for instead of being forced to go across the country in the middle of nowhere. This is the stuff that I deal with, which is why I love clients. They respect and appreciate the advice. It's probably why you don't listen to your own spouse. You get what I'm saying? Because your spouse is just there. You always say, the advice is worth what you pay for. Well, if you paid nothing for it, it's worth nothing to you. This is why some of us don't listen to our parents still. Hopefully that ship has sailed, but the ship has sailed where you now listen to them, not that they're not with us, God forbid. But these are the things that I just see often. And I want you to be better. This should be the theme of everything you do, is to be better. To enhance your situation that you're doing. Learn from others. Yes, a smart person learns from their mistakes. I get you. I believe you. But a smarter person learns from other mistakes. Why don't you just take a look at the situation you're in right now and learn from what's happened? History repeats itself. You know, what's a great example of that? Go watch The West Wing. They're still talking about Middle East problems. They're still talking about issues with China. They're still talking about inflation. They're still talking about military and wars and conflict with other countries. There's always problems. I get it. But the idea is where you don't learn is what frustrates me. So, I like bear markets. Please take advantage and don't just dump it all in tech companies or S&P 500. You got to diversify. Because what's great today may not be great tomorrow. And oh, by the way, tech was fantastic in the 90s. And you saw what happened from 2000 to 2014. The market stayed flat. It got destroyed and crushed. I truly believe, my opinion, there's always a reversion of a mean. And that's why emerging markets has really sucked in the past 10, 15 years, because it had a boom in the 90s and even in the early 2000s. Diversification was key. When you take a look at everything and squeeze it all together, there probably is a realistic probability that everything has its average expected rate of return investments, and over time it's going to get it. So if there's a period in time where something is doing 20, 30% returns, eventually there's going to be a reversion of a mean. So let's switch gears here. I want to go over some other information and data with you. By the way, folks, if you're just joining me, you're listening to Gabriel Sheen, Certified Financial Planner, and your host of More Knowledge, More Wealth here. And every weekend, we're talking about all important topics of personal finance. And today we're talking about just a whole bunch of topics here, but I wanted to talk about shelter costs. Within the inflation calculator, it's just finally heading lower. And if people want to know what is a shelter cost, it's kind of what you think. Everything that encompasses just a house. This could be rent and mortgage. These are the two biggest ones that are out there. Property tax, utility bills, all of this is included. Utility, including gas, electric, water, sewage, garbage, and so on. So the reason I bring this up, I just thought it was fascinating. I came across this just the other day. I thought I would share it with you. But let me just kind of tell you what my notes say. It says that shelter inflation has trailed headline inflation on the way up and on the way down. Shelter is the heaviest weight in headline and core inflation calculation. Now, probably not earth-shattering like, oh my gosh, I had no clue about this. We know that the affordability index has been quite high. But when you take a look, you're starting to see some stabilization where normal inflation is dropping ahead of shelter inflation, which means we could be seeing, now it did peak in March of 2023, and inflation did peak in June of 22. All I'm saying is you're starting to see those trends go down, and shelter inflation seems to be following at a later pace. Yet again, important things to take a look at. And when you factor this in with everything that's going on, when you look at all 113 asset classes, and when you take a look at year to date, or when you take a look, we have literally one of the lowest levels of where 5 of our 113 asset classes have lost money, which means 108 of them have actually in the positive this year. 2024 is a good year. When you start getting north of 10, 15% returns on the stock market, the S&P 500, let alone the other asset classes, you should probably be a bit pleased. You should be happy at what's going on. All I'm trying to tell you is that we see people right now unhappy because they have all their eggs in one basket and they always buy too high. This is where a disciplined approach is absolutely crucial to the success of your portfolio. This is why staying disciplined, diversified, and emotionless. The emotionless piece to investing is so important because once you realize everything has a purpose and a strategy, to you it's a problem when you lose money, when the market goes down. To us it's a procedure. There is a way to take advantage of market volatility. And it could be tax strategies. It could be financial planning strategies. It can be investment management strategies of knowing what to sell and what to buy. I don't care if something's up. I don't care if something's down. I don't care if everything's up or anything's down. You always have to have a strategy of what to sell and what to buy. Remember, you got to sell first and then you buy second because you need the money. And where are you going to buy? What you're going to buy. And this is where people fail. And I'm just telling you because I want you to be successful. You deserve to be successful. And if you want help to be successful, we want to offer 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short. We'd love to help get everything you need, put it together, and tell you what you should be doing. And listen, nobody, and I mean nobody, does everything right. There's always a way to improve. It could be the car you're driving, it could be the house that you're living in. Those are two sensitive topics. But oh, by the way, if you can afford it, who cares? But realistically, it could be how much you're saving, where you're saving, what are you investing in, what's your discretionary, non-discretionary spending? Are you saving first? Are you spending second? Are you taking advantage of all the opportunities that are available to you, such as using your credit card more, somebody else's money, have it for 30 days more where you don't use it for free, where you could potentially be earning interest in the interim? Or if there's a fraud claim, you could be utilizing somebody else's money versus your money, and you get rewards on top of that. There's just so many basic concepts of mileage programs, to insurance, to umbrella, to liability, to trust, to so many different pieces, not including those who own rental properties or businesses, that there's so many strategies that people are not taking advantage of. This is why we're offering a free financial assessment where we'll give you 1 to 2 meetings, 1 to 2 hours of our time at no cost, folks, to help relate this show to your specific situation. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short. People are going through a lot right now. I get it. It's never going to change. It's human nature. Sometimes we find things to put us into duress. Sometimes people are bite off more than they can chew. Sometimes this is why people are always late. It's just who they are. It's a psychological situation they put themselves in to always be on the go. And nothing is wrong with that. I'm just saying, know what your strengths are and know what your weaknesses are. And in a situation with your finance, you can't afford to be late. Something in your retirement, do you really want to be late? If it's something in your overall happiness, is that something you truly want to delay? This is something that you should be analyzing. That was a fast show, folks. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON. like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. Have a great week, and God bless.